The calendar has flipped to February 2026, and if you're an investor watching the Indian market, you might have noticed something interesting happening with the energy sector. Specifically, the narrative around lithium, the so-called white gold, has shifted dramatically in the last 6 weeks. If you wrote off lithium stocks after the crash of 2023 and the stagnation of 2024, you need to pay attention right now because the bottom is officially behind us. Welcome back to the Paisa Forever channel. Today we are doing a deep dive into the state of lithium investing in India as of February 2026. We are not just talking about hype, we are talking about real production, actual government policy changes that happened last month, and where the smart money is moving before the fiscal year ends. Let's start with the big picture. Why are we talking about this now? Because the price action is undeniable. Entering 2026, global lithium prices have surged approximately 25%. We are seeing a rebound driven largely by supply cuts from Chinese producers who refuse to sell at a loss, combined with a massive uptake in grid storage demand. This matters to you because the market consensus is that the bottom has passed. If you are sitting on the sidelines waiting for prices to drop further, you are likely missing the boat. Analysts are predicting prices to test the $28,000 per ton mark later this year. The window to capture this upswing is open, but you need to know exactly which vehicle to enter the market with. Now, when Indian investors think of lithium, the first thing that usually comes to mind is Jammu and Kashmir. We all remember the headlines about the massive 5.9 million ton reserve discovered in Riyasi. But here's the reality check for February 2026. The G2 exploration survey for those reserves was completed just last month in January. The data suggests that while the lithium is there, the extraction potential is lower and more difficult than the initial hype suggested. Why does this matter to your portfolio? It means you should not be betting your money solely on companies claiming they will mine in J&K tomorrow. Commercial extraction there is still years away. The market knows this, and it has already priced in that delay. If you are buying stocks based on J&K headlines today, you are buying yesterday's news. If you want to look at where the real action is, you need to look at Chhattisgarh. While the cameras were focused on the Himalayas, the Katghora block in Chhattisgarh has quietly become India's first active lithium focus. This is a hard rock deposit which is generally easier and faster to mine than the clay-based deposits found elsewhere. The concentration levels here are between 168 to 295 parts per million. It's not world-class high-grade like Australia, but it is accessible. For an investor, this is the only domestic mining play that has the potential to generate value in the near term. You need to keep a close watch on the private miners involved here, like Mikey South Mining and the listed entities partnering with them. This is where the first mover advantage actually lives. But let's be honest, mining is risky. It's capital intensive and prone to regulatory hurdles. If you want a safer, large-cap route to play the lithium value chain, we have to talk about Reliance Industries. There were rumors floating around late last year about delays in their new energy timeline. However, in January 2026, Reliance confirmed that their 40-gigawatt car battery Gigafactory in Jamnagar is on track to start operations this year. This is massive. Reliance is not just building a factory, they are building an integrated ecosystem. By investing in Reliance, you are getting exposure to the lithium value chain without the volatility of a small-cap mining stock. They are the safest bet for conservative investors who want a piece of the pie without losing sleep over commodity price fluctuations. Moving down the chain, we have the traditional battery giants, Exide and Amara. For years, these stocks were seen as legacy lead-acid battery makers. That perception ends this fiscal year. Both companies are scheduled to start commercial lithium-ion cell production by the end of March 2026. This is a critical distinction. Until now, most Indian EV companies were just importing cells from China and assembling them into packs. That's a low-margin business. Making the cells yourself, that's high-margin manufacturing. This transition from assembly to manufacturing is what triggers a stock re-rating. If these two companies successfully roll out commercial cells in the next few months, their valuation multiples could expand significantly. Now, let's talk about the regulatory environment because the government just gave this sector a massive shot in the arm. On January 29, 2026, the government officially approved the National Critical Mineral Mission or NCMM. This isn't just a policy paper, it's a financial framework. The mission is designed to secure the supply chain for critical minerals by offering incentives for mining, processing, and even overseas acquisition. Why does this matter to you? Because government backing de-risks private investment. Companies falling under the ambit of the NCMM are likely to receive subsidies and faster clearances. When you are analyzing a stock, check if they're eligible for benefits under this new mission. It's a safety net for your capital. However, not all government schemes are performing equally. We need to look at the PLI or Production Linked Incentive Scheme. The data as of late 2025 is sobering. Only 2.8% of the targeted 50 gigawatt-hour capacity has actually been commissioned. The vast majority of that is coming from Ola Electric. Many other players are facing technology transfer delays or supply chain issues. The takeaway for you is to be very skeptical of companies that pitch their stock based on future PLI gains. Unless they are Ola or Reliance, those gains are theoretical. Stick to the players who are actually delivering capacity, not just promising it in a PowerPoint presentation. There is also a backdoor way to invest in lithium that doesn't involve mining at all. It's called urban mining or battery recycling. With the first wave of EVs from 2018 and 2019 now reaching the end of their battery life, the supply of scrap is skyrocketing. The cabinet recently approved a 15 billion rupee incentive specifically for battery recycling. Companies like Tata Chemicals and Gravita are key players here. Think about it. Recycling old batteries is currently the fastest and most profitable way to get lithium domestically because we don't have active mines yet. These companies are harvesting lithium from waste, and with the new subsidies, their margins are looking very attractive. We also need to talk about the technology risk. Lithium is great, but it's not the only player in town. Sodium-ion technology is rising fast. The Chinese giant CATL has already started mass-producing sodium-ion batteries for 2026 car models. These batteries are cheaper and work better in the heat, which is perfect for India. Reliance and Amara are actively diversifying into this tech. When you are picking a stock, ensure they have a sodium-ion strategy. You want a company that can pivot if lithium prices get too high again. You want a hedge against technology disruption. So, how do you actually buy into this? Picking individual winners is hard. Maybe Exide wins, maybe Amara wins, or maybe a new player disrupts them all. If you want to avoid that stress, look at the Nifty EV and New Age Automotive Index. This index covers the whole ecosystem, from auto manufacturers like Tata and Maruti to battery makers like Exide. It's the safest, low-cost way to invest in the entire India EV boom. You get the growth of the sector without the risk of a single company blowing up. Finally, don't limit yourself to Indian borders. The domestic options are still limited compared to the global market. Smart Indian investors are using the LRS or Liberalized Remittance Scheme, which allows you to invest up to $250,000 per year internationally. You can use this to buy global giants like Albemarle or ETFs like LIT, the Global X Lithium and Battery Tech ETF. These companies are the established leaders. They have active mines and massive cash flows right now. Using a portion of your portfolio to global exposure diversifies your risk and gives you access to the mature part of the lithium cycle that India hasn't reached yet. Before we wrap up, let's bust 3 major myths I'm hearing in investment circles this month. Myth number 1. We found lithium in J&K, so we don't need to import anymore. That's false. As of 2026, we still import nearly 100% of our cell requirements. Domestic mining at a commercial scale is still 5 to 8 years away. Imports will continue to rule the market for the foreseeable future. Myth number 2. Lithium stocks only go up if EV sales go up. This is also false. In 2026, the biggest driver of demand is shifting towards grid storage, massive batteries used for solar and wind farms to store energy. This sector is growing even faster than cars. Look for companies servicing the power grid, not just the scooter market. Myth number 3. Any company with energy in its name is a good lithium buy. Please don't fall for this. Many small cap companies are trading purely on hype with terrible financials. Stick to companies with actual PLI status, active recycling plants, or confirmed mining blocks. So here's the bottom line for February 2026. The lithium market has reset, the prices are climbing, and the Indian government has finally put the policy framework in place with the NCMM. The days of speculative hype are over. We are now in the execution phase. If you are a conservative investor, look at Reliance or the Nifty EV index. If you have a higher risk appetite, watch the transition of Exide and Amara into cell manufacturing, or look at the recycling plays like Gravita. And if you want the best of the best, use the LRS route to buy the global leaders. The opportunity is right in front of you. The volatility has scared away the tourists, which means the valuations are finally starting to make sense for the serious investors. Do your own research, check the financials, and as always, don't invest money you can't afford to lock away for at least 3 to 5 years. Thanks for tuning in. If you found this breakdown helpful, make sure to subscribe so you don't miss our next update on the semiconductor sector. Happy investing.
Disclaimer: this video is for informational purposes only and does not constitute financial advice. The market involves risk, so please conduct your own research before investing.